Well, thank you very much, Jeff and Matt, for having me. I'm really excited to be here, you guys. I don't get to talk about what I do very often at all, so this is such a treat for me, and I hope you guys are able to take something away from it. I've been with Fairway for about 14 years now. I have been in the mortgage industry for 26 years and have always been in underwriting. So I've seen the ups, the downs, the no docs, the stated income, stated assets, and where we are today. So I've been through a lot of it. Yeah, and hopefully I can share my knowledge with you today.
Love it. Well,
yeah, hey, one more bit of context here too. Like Michelle, we've been with Fairway about 13 years. Michelle's been here 14 years. When we started at Fairway, she was our underwriter. She was assigned our region to our branch and then became a regional underwriting manager and now the head underwriter. So when you're listening to this, one, there's a relationship there, which is why she's here. But think of it this as when she speaks, this is the person that runs the team that approves the loan for your buyers. And as a loan officer, this is the person that runs the team that approves our borrowers and our loans. So it's really cool to kind of realize that you'll figure out really quickly that she's super sharp, she's super kind, she's super nice, but underwriters are real people and they care a ton about the transactions happening and you guys out here. So just kind of keep that perspective as you listen. So,
all right, we're going to dive right in here. So first question, what does an underwriter actually do, Michelle?
Okay, so an underwriter is somebody who reviews the overall risk of the loan. Obviously, we look at all the documents that your buyer sends in, and we want to make sure that we're making a good saleable loan. Our goal, well, first of all, we sell on the secondary market to investors. They're the ones that make the rules, right? So we have to make sure it fits into their rules. But also, we want to make sure that we're doing your buyer a good deed. We want to make sure that we're putting them into something they can afford, that we're not setting them up for failure. Buying a home is probably one of the biggest decisions somebody will ever make in their life, as well as being probably their largest financial asset. So we want to be a part of that process to make sure it's a good decision for them.
All right, so can you give us a general overview of the process and what makes this process so important?
Okay, so basically what we do is once the loan goes to your lender, they are going to get it all processed, gather all their documents, and they're going to get it into underwriting. They get it submitted to us. We have an amazing team that literally goes through and just reviews everything. We're looking at their credit just to see what the history was, what they have opened. We're looking at what debts they have. We're looking at how in-depth is their credit. What kind of assets are they utilizing? Do they have sufficient funds? Where are they coming from? We look at their employment. Do we think that they've got stable employment? Is it on the up and up? And most importantly, what we're looking at is that property, because we do want to make sure that they're paying for a property that is worth what they're paying for. We definitely don't want to put them in a home that is overpriced, and we want to put them in something sound and safe.
So kind of follow-up question to that, are these Fairway guidelines? Like what are you trying to, what's the goal here?
Okay, so no, they're not Fairway guidelines. So what we do is, I'm sure all of you know, there's 4 different loan types typically. There's your conventional loans, there's your government loans, which are FHA, VA, there's your USDA loans, and then there's your non-conforming, your jumbo loans. We're going to take jumbo out of this. Those are all our investor-specific loans where there's people on Wall Street who make the rules, right? So we're looking at our conventional, our FHA, our VA, and our USDA. All of them are government regulated. They all set the guidelines for how we need to look at deals. And it's all their rules. What we do is we have these automated underwriting systems, which probably some of you are familiar with. We've got Loan Prospector Advisor, which is our Freddie Mac, and then we have Desktop Underwriter, which is Fannie Mae. Those 2 systems are used for all of the VA, FHA, and conventional loans. And then there's something called GUS. Has anybody heard of GUS? Of course you've heard of GUS. Yeah, a lot of people haven't heard of GUS. We don't love GUS, but it's a great tool, and that's to put people in those USDA, the rural development homes, okay? And that's just a different system. So we run through the loans through these automated systems, and those systems are the ones that actually determine the risk of the loan. And what the underwriter does is they're just validating. They are validating every piece of it and making sure the whole picture makes sense. So whereas that system is validating or telling us what we should be looking for on each piece, once we get the piece, then we can make the story and see if the story has a happy ending.
Love it. So once the loan closes, is there an auditing afterwards? Like, you know, does that happen? I'm just, because this is stuff that people, I'm just curious your thoughts on, or if you don't mind explaining that. Is there an auditing process after the loan closes?
Yes, and I don't know if any of you have been reached out to after closing where we had to get in touch with your buyers about something because something happened after they closed. Could have been immediately after, could be 6 months after, could be 2 years after. So we do have a few different types of auditing processes. First of all is our internal audit. We do internally audit all loans right after they close to make sure we have all the documents that we think we need to get it over to our investor. That's first and foremost, okay? We try to obtain anything that may be right after closing, you know, especially because the buyer, they're still in that new house mode. They're happy to help. They're so happy to be in their home. They'll get us what we need. Then we have our investors. Our investors will audit our loans. There are a couple things that they do. Every type of investment property gets audited. So if you have a buyer who is purchasing an investment property, just know that wherever the loan ends up, whether it's Freddie Mac, Fannie Mae, well, really just Freddie Mac or Fannie Mae, because that's the only investment, that loan will be audited, okay? The second type is the higher risk loans, right? You're looking at your higher LTV, your lower credit score loans. They will pull those and audit them just to make sure that we made a sound decision, all right? The third is self-employed borrowers. You know, tax returns are fun, and they're gonna pull those loans and make sure that the income calculation we came up with, they agree with. So they'll look at those as well. And the last is a random audit. In that random audit, they will take a sample of, you know, whatever sample, what percentage that they choose, but then they will also audit every single early payment default loan, which means that if your buyer were to default within the first 6 months, they're pulling it to see if we made a mistake. Do we make mistakes? Absolutely. We do. Do you want to talk about scratch and dent? Right.
Yeah, and so just for clarity, Fannie Mae, Freddie Mac, they own about 60% of the loans in the entire mortgage market. So this isn't just Fairway, this is every lender out there. Even big banks, you know, if the big bank makes the loan and they collect the payments, they're likely selling it to Fannie Mae or Freddie Mac and have to go through this exact same process. So just little clarity on there. So, all right, so we audited a loan, we made a mistake. What happens then? So there's something called a buyback and then something called scratch and dent. So what does that mean?
Yeah, so if we make a mistake, they're gonna come back to us. And whether or not the loan is performing or not performing, they're gonna come back to us. And they're gonna say, hey, you made a mistake. We're gonna look at it. Did we really make a mistake, or is it something that we feel that we can refute? Can we rebut this with the agency? I'm gonna be honest, a lot of times we have to agree to disagree with them, because you know what? You're gonna get two underwriters who never look at the loan exactly the same. They're gonna look at it a little bit differently. It's not a science, it's an art. Whereas I might feel comfortable with something specific, the investor doesn't like it. In a case like that, as long as I feel I can support it, I'm never gonna tell my underwriter that they were wrong, because they did what they could fully support. We just have a differing of opinion. However, mistakes are definitely made, and if there is a mistake, for example, we've had times where somebody has just flipped numbers on an income calculation. You know, that made it go from a 36 DTI to a 52% DTI. All of you guys know what DTI is, correct? Okay. So it made it go to a 52. Now, all of a sudden, this loan is no longer eligible for sale. Very simple mistake on the underwriter's part, okay? Sometimes we're able to fix the mistakes. For example, something like that, if maybe we had overtime income we didn't use, we could just go ahead and use the overtime income to get that debt to income ratio back down, problem solved, right? Maybe for whatever reason, they didn't show enough assets, the closing costs, something went up at closing and we didn't have enough assets verified, we can see that we get additional bank statements to show that they have them. Those are easy fixes. But then there's the ones that aren't, the ones that we really cannot do anything with. We have to get those loans back. And basically that means that we take them back and we have to hold them until we sell them in something called a scratch and dent, okay? Scratch and dent is how do you explain it? It's like a secondary market for damaged loans. scratch and dent, right? You guys have seen like appliances being sold in scratch and dent sales. It is a damaged loan. Pretty much when we sell that, we have to take a loss on it. So we're selling it for, I don't know, the highest I think I've seen is at 93%. So we're losing another 7% on the loan, aside from the revenue we made on the loan when we sold it to Fannie and Freddie. So now we have to take all that revenue back, and we basically are now just taking a full loss on this loan.
Yeah, I've got to just to bring some color to this, because prior to Fairway, nobody really explained that to me. And the way that they explained it, when they broke it down, it's like, hey, let's say it's a $400,000 transaction, right? You know, you just serve the client, you made your commission, everything's great. That's how, you know, so Fairway takes the loan, they securitize it, they get paid, and then it gets audited, and then there's a buyback, right? And then it's a scratch and dent loan, so they're having to take it to a secondary investor. There, at the time, it was like, hey, it was averaging like 80%. So on a $400,000 loan, you know, it's like a 20% haircut. So literally, like, it's like waking up and like, you know, I don't know about you, I do every once in a while, I'll wake up and I'll look at my bank account, see what's in there, you know, so I know I've got to pay some bills. Well, it's like waking up and seeing your account's been debited $80,000. And there's not a like, hey, buddy, old pal, like, let's talk about this. It's, hey, we debited your account, you're out 80. And it takes a lot of loans to make that up. So my point of even bringing that up purely is from a standpoint of like, when you have loans and the client's frustrated because it's like, hey, there's challenges to the loan, and we knew it out of the gate, you know. And sometimes you go get documentation, and then it's like not the right stuff, and then we go back and ask, and then they get frustrated. Please understand some context there, because at the end of the day, we've got to be able to take that loan and get it securitized correctly, right? And so if we're cutting corners, and then all of a sudden the bank's at risk of losing that type of money, which is real money. It's like $40, $50, $70, $80,000. Those are massive hits. And it's like, hey, we don't want that. So just understand that when you're talking to consumers and they're frustrated, don't be like, yeah, that lender stinks, man. Like, let me get you to some other body. You know, it's like, hey, let's find out what really is going on. You know, because in all honesty, more oftentimes than not, there's a reason that we're asking for additional documentation, because we've got to make sure that we have a comfort level of moving forward and making sure that this loan's going to work on the secondary side. So if we got a lot of questions. If you're cool, could you hang tight to that, because we're going to do a Q&A at the very end.
Okay, I would probably forget about
Okay,
that.
well, know what? You know what? Fire away. What you
Go
got?
ahead.
It's about the scratch and dent.
Okay.
So I just wanted to know, is that specifically like when you have a new a buyer and they have a new loan, and immediately their loan is serviced by someone else? Is that considered you guys
No,
selling
no, no,
or
no,
the scratch and
no.
dent?
So all of our loans, that is a great question. All of our loans, we do sell on the secondary market, right? So that's not who services the loans. That would come a little bit later on. So if all of a sudden at some point, and okay, this probably is confusing. If they get a service transfer throughout the time of the loan, that does not mean it was sold in a scratch and dent. That just means the servicing was transferred.
You'll never hear about it.
You'll never know, and the buyer will never know either if we sold it in a scratch and dent, because if we truly made a mistake that we cannot rectify, the buyer is never going to hear from us. And you know, we make mistakes throughout the process too, before the loan ever gets to closing. It happens. It doesn't happen often, but it does happen. And when that happens, you as an agent and your buyer will never know this, because you know what we do? We use our own cash to close the loan. If we've approved the loan already, we're not going to come back and tell that buyer that they can't have the house because of a mistake we made, okay? So that is one thing that we do is we will close the loan with cash, and we'll just have it sold in a scratch and dent beforehand. So they'll never even know it. That's a great question.
I think one thing that gets confusing if you don't deal with this every day and you're not in the mortgage business is what does the investor mean and what does the servicer mean? Like the investor, Fannie Mae, Freddie Mac, Ginnie Mae in the example of government loans. Think of it like it's a rental property, right? It's an asset. The Fannie Mae, Freddie Mac's the landlord. The servicer who collects the mortgage payments, they're the property manager. Okay,
that's a great analogy.
That's a good way to think of it. It's who owns the assets, the end investor. The servicer manages the asset on behalf of the owner of the asset.
Good question. All right, moving right along. Time frame. What is the time frame to underwrite a loan?
Okay, so typically I'll give you the overall process. For us to get to a loan, once it gets on our desk, it's typically between 24 and 48 hours. Not specifically for that one loan. When an underwriter is assigned a loan, let's just say they have a loan assigned to them today, it's due out today by the end of the day. But as far as the agent is concerned, from the time that your lender has got it into underwriting, it's typically a 24 to 48 hour turnaround time. As far as underwriting every loan, you know, it's all gonna depend. I say it depends on how the loan is processed. Some loans, we can be start to finish in 20 minutes. You know, you've got those loans, super easy. Buyer is salaried, works 40 hours a week, check on the income. Credit's decent, all the assets are coming from their checking or savings, check on the assets. You know, typically when something like that happens, the only thing we're waiting on is the appraisal, right? But you have your credit approval.
If you ever hear from a Fairway Custom Mortgage Loan Officer and they say, hey, this is a golden ticket, like, that's what she's referencing. Like, it's like, might as well be cash. We're going like, that thing will close so smooth, it's insane. Please relay that to your sellers if you got multiple offers, because it's like, hey, this guy called me from Fairway and said this thing is like pure gold. Like, that's what she's referencing there. It's like the loans, the 30% of the clients that we wish were all like that. You're like, oh my God, this is great.
All right, how many times typically does,
I was going to say,
we're
then there
done?
are the
Oh,
other
sorry.
ones. Then there are the other loans. Hang on. The other loans where you have, you know, the borrower is self-employed. They have 5 businesses. They have 20 properties. All of their assets are everywhere. They're transferring money back and forth, back and forth, back and forth. And it's, you know, we have to ask them almost for blood, right? Those take just a little bit longer. Those can take, you know, on average of 2, 3, 3.5, sometimes 4 hours. Sometimes we can't get it done in the same day because we need more documentation to physically make a decision. Yeah.
It varies.
All right, so how many times typically does a loan go into underwriting and at what point in the loan process?
Perfect situation once. Doesn't happen very
Yeah.
often because most often than not, we're waiting on the appraisal, the title, the homeowners, the third-party documentation that the buyer is not responsible for, you know, getting to us. Typically, once would be perfect. Ideal is twice. Once for us to do our initial review, and the second time for it to come back for those third-party documentations, for us to look at the appraisal, title, homeowners, all of that stuff, tax bills. That is the ideal. I would say more often than not, 3 times is probably when it comes through. First time for us to make our decision, second times to fulfill any outstanding credit conditions we may have asked for, and the third party. And, you know, typically there might be something, we saw a large deposit on a bank statement that you just provided, or that your buyer just provided to us. Now we have to source that. So I would say probably 3 times is.
Makes sense.
Yeah.
Can you walk us through like the verifications that have to happen when you're underwriting a loan?
Yes, so we verify their credit. Obviously, we pull credit reports and we look at that. At times, if they are renting their current property, we do have to verify their rent, get a verification of rental from their landlord to show that their payment history and what their current housing payment is. We verify their income, we verify their employment. We do that through documentation, pay stubs, W-2s, tax returns, and we also call the employer. We want to make sure that, you know, if the process is taking 30 days, that at the time we looked at those pay stubs, which may have been dated March 31st, now is April 27th, maybe March 31st is the last pay stub, and closing is set on May 10th, we need to make sure on May 10th they're still employed at the time of closing. So we verify their income and assets. And of course, lastly, we need to verify that all of their assets are coming from an eligible source of funds to close. There's definitely funds that are not eligible to use in a closing. Gifts from non-family members, unsecured loans. If a loan is unsecured, if they just go, you know, to their local bank and just get, you know, a small little personal loan, those funds cannot be used for closing. So little things like that.
There's a lot of mattress money that comes up out of the side.
Lots of mattress money, yes. Cash saved at home, things like that, fun stuff that we have to look at.
All right, so what is a rush request at Fairway?
Good question. So because we do everything on a turn time, typically, so for underwriting, we post our turn times. On any new loan that comes in, we say you're gonna have a decision within 48 hours. Typically, we get it out within 24 to 48, but we guarantee 48 hours. So anything that comes in today will be due out by Friday, Wednesday, yeah, Friday by the end of business, okay? And then our conditions. So conditions are what come in after your initial decision has been issued to your buyer. It has to go in for a condition review. That is 24 hours, okay? So anything that comes in today will be due out tomorrow by end of business. Now, let's just say, for whatever reason, your buyer is procrastinating. They are dragging their feet. You can't get in touch with them. The loan officer can't get in touch with them. They're just being stubborn about getting their documents, but you have a closing tomorrow at 11 a.m., and right now you do not have your clear to close. The documents finally come in, okay? Your closing's at 11. The package needs to go out tonight, right? So Jeff will get those documents, he'll submit it in, and he'll submit what's called a rush request. Basically, that is for anything that is needed before the posted turn times, okay? Rushes can be for anything. It doesn't necessarily have to be for a quick closing. Perhaps you guys don't even know that they're asking for a rush request, but you just meet Matt or Jeff for the very first time, and they're trying to wow you with their charm and their efficiency and their speed. They may be asking for a rush request just to get that back to you to show you how efficient Fairway is.
There have been a lot of times where I've had clients that are like, hey, closing's Friday, like payday's Friday, right? So they're like literally pulling pay stubs at 7 a.m. as soon as they can get access to their portal. We get that stuff submitted back by like 8 a.m. and like we request a rush request. They fully sign off on it. That's the last thing, and then we're into closing, and we're rolling. So there's things that involve, and there's a lot of banks. A lot of banks don't have that. You know, bigger banks, rush system doesn't exist. If you're getting paid Friday, you're closing Friday, you might as well push the closing because they ain't closing. There is no rush request. You got 48 hours to wait, push it next week. That's just how this stuff is. So.
Yeah, the coolest thing from our side about the rush request system is they pretty much say yes now and ask questions later. And so it's yeah, I mean, you can't abuse the system, but in the heat of what's going on, they just say, hey, let's get it done. We got to go close. Yep. And then get mad at us later if we do it too often.
We try not to abuse it. So what is like that? So all right, let's say that I have a difference of opinion with an underwriter. And the underwriter's like, yeah, I don't like what you've got. I don't like what this borrower's provided. And they say no. Is there an escalation process? Can you talk through that? How does that work?
Do you ever disagree with an underwriter?
Not you.
Okay, oh, well, good answer. So here's the thing. The underwriter, as knowledgeable as they are, they have comfort levels as well. And again, because it's not a science, they have differing of opinions with each other, with the loan officers, with everybody. They may say no on something, or they may not see it the same way as the loan officer does. We do have an escalation process. So if they don't agree, they can request an escalation on that loan. It will go to the underwriter's manager. The underwriter's manager will look at it. If they don't agree, it will come to me. I'll look at it. If I don't agree, I will send it to my boss. If he doesn't agree, it basically goes to our CEO. I've always said we don't say no until the CEO says no. 99.9% of the time, we don't say no because it just boiled down to a comfort level. Can I make sense of this, and can I support why I did this? Yes. And I don't necessarily want the underwriters making some of those riskier decisions. I would rather do it myself because I can support it. It will be my thing. How often have we said no?
Very rarely.
Right. Now, do we ever say no? Every once in a while we have to, because let's just face it, it doesn't meet the guidelines. And what did I say? Have I said the golden rule yet?
I love the golden rule.
Those who have the gold get to make the rules. So we don't have the gold. It's Fannie, it's Freddie, right? If it's the golden rule and we can't do it, we can't do it.
Yeah. I mean, literally, we just had a client that everything was perfect on her credit, and we pulled a report, showed they had a prior house that they owned, and it was foreclosed. It just never got processed, and it was an issue for VA. So we had to say, hey, unfortunately, we cannot go VA. It doesn't happen. So it does happen. So.
It does happen, but if everybody's doing their due diligence up front, it doesn't happen very often.
Agreed.
So as a realtor in the process, can I have access to the underwriter? Can I contact the underwriter about an active transaction?
No. Probably one of the only times I'll ever say no in this career. You are not able to have access to us, nor are your buyers. And there's a reason for that, okay? We all have hearts. We all have sympathy. We all have emotion. We all have feelings. We have to stay as neutral as possible to the transaction. We have to look and see the facts. We have to look and see what's on paper by talking to your buyers about some of the struggles or challenges they've had, or talking to you to let us know what struggles or challenges are going on. It could tend to sway our decision in a way that it doesn't need to go. So that is why you directly cannot have contact to us. However,
but they really want the house.
I
And they're really
want
nice.
them
No,
in the house,
no,
but
here's
I will send them a card after closing. I just can't talk to them.
this is the coolest thing about Fairway and why we've been here a dozen years. You can't have direct access to the underwriter, but every LO in the room does. Stephanie, our processing manager, who Michelle is staying at her house, does have access. Our sales managers, Carl in the back, has access. I have access. Jeff has access. We listen, we understand the situation, we understand that it needs to close and what went into the transaction. And every underwriter that we have wants to do the loan. They just don't want it to end up in the scratch and dent pile and us lose $100,000 on it, but we want to do the loan. And so I can't tell you how many times we've had conversations. It's gone through the escalation request. Our regional underwriting manager, Pam, who's just awesome. You get her on the phone. She's come up with solutions. Like, we've talked out many times, like, hey, okay, it doesn't work this way, but hey, what if you do A, B, and C? What if you do this, get some kind of lender credit, pay a car down to non-payments, get it out of the debt ratio, run it through this investor, and let's go close. Stuff like that happens on the back end all the time. And that is one of the greatest things about this team that Michelle runs. And so anyway, just wanted to make sure that I understand that we got access and we have those conversations like
They know how to get
a
in touch
lot.
with me.
And they pick
Everywhere.
up the phones. It's not just emails and I'll get back to you 2 days. It's phone calls and stuff gets worked out on phone calls.
So what is, I'm just curious, what underwriters look at, look for, rather, when they're making a determination on signing off on a loan? Are there specific things that you're...
Yeah, I mean, so okay, we look at their credit, we do look at their income, we look at the assets, we look at the property. Remember, one of those things we're trying to do is make a saleable loan, something that not only will our investor and our servicer take, but something that the borrower is comfortable with. Because remember, if that underwriter is on the other end of a phone call where somebody says to them, you just lost us $200,000 for a mistake you made, they never make the same mistake twice. So they want to be very cautious about what they're looking at, careful, due diligence, and really just making sense of the loan. Because again, we want to make a good loan that we can sell, but we also do not want to set that buyer up for failure. That is the hardest part, knowing that if you're putting somebody in a home that on paper you know that they can't afford, it's just really, you're trying to make sense of doing it. I mean, and I'm sure you guys don't want that either for your buyers, right? So, yeah.
So what are the 3 most critical pieces of data you need from buyers ASAP in the process?
ASAP. 2 would be, you guys need to push them. We need income docs, asset docs. That is immediate. From the lender, we need a complete application. So we have the picture ahead of time, we can get a credit report, and that's pretty much the 3 things we need ASAP to take a glance to see if we can get out a pre-approval for your buyers.
Please make sure y'all are coming alongside us on that, because when you're again, at the beginning of the process, they're excited, they're pumped, they want a house, they'll get whatever they need, and sometimes it's not easy access. You know, sometimes they have to dig and track down things, whether it's divorce decree, bankruptcy paperwork, tax returns, what have you. They don't have it on the ready. The sooner they are put on the ready, like they're made aware of it, the better it is as far as getting that stuff. I want to pop this question in here because I think it's important, because you covered it yesterday and I thought it was great. What are the 3 most important things, and take note here, the 3 most critical things that on a contract that agents that need to know about?
Okay, so the 3 things on the sales contract, and if any of you watched the promotion videos that went out for this, I did say I would share that with you. So first and foremost, the most important thing that you need is the property address. It needs to be 100% accurate, zip code, drive versus street, avenue versus circle, okay? City, that's really important. I know there's a lot of areas, and I work nationally, so I've seen this a lot. I know there are a lot of areas where, like Charlotte, North Carolina can cover a bunch of different areas, but each area has their own specific city and state, but the mail would still get there if you had Charlotte, North Carolina in the correct zip code. Okay, why is that so important for us? Are you guys familiar with what a property inspection waiver is? Okay, so we run all of our loans, especially on the conventional side, through our automated underwriting system. They're looking at that address that was inputted they may give a property inspection waiver, which means no appraisal is needed. If the buyer is okay with it, hey, that's a win in everybody's mind, right? How easy is it to close transactions that don't require an appraisal?
I love that.
Pretty easy, right? So that's super important. Now I'm going to give an example. It might not be correct because I don't necessarily know around here, but let's just say we inputted the address as Charlotte, North Carolina, and then we got the property inspection waiver and all is great. Well, comes to find out, the true address is Matthews, North Carolina, not Charlotte. Put in Matthews, we've lost that property inspection waiver. You're 2 days from closing, we don't have an appraisal. Now we have to order an appraisal because we can't deliver that loan. So it's super, super important, and as we know, an appraisal could be something that could make or break the deal. So super important that you guys have the correct address from the very beginning because that's the address we're going to use, okay? Second thing, borrower's name. You may have, I'm sure you guys have good friends that you help. You know, you've got Bill Smith. Bill Smith actually goes by David. It's William David Smith. So Dave Smith wants to buy a home, and you write up the contract for Dave and his amazing wife, Jennifer. Jennifer's real name is, I don't know, Michelle. Michelle Jennifer. But we're gonna do a loan for Dave and Jen, right? Because we love Dave and Jen. So our contract's written out in Dave and Jen Smith. Well, now we're pulling credit under David and Jennifer Smith or whatever. We are running it all the way through. They get to closing, their photo IDs, their lovely driver's licenses, say William David and Michelle Jennifer. Now we have to go back and pull a new credit report. Could that credit report show something different than it did initially? It could. It could, especially on common names, okay? Super important those names are accurate. I don't know if you guys do get driver's licenses at the time you do your contracts. Please make sure you're getting their full legal name as it appears on their ID, okay?
So that's what you would say, like, hey, could you give me a favor, pull your driver's license and text me a picture of it? Use that name exactly?
I don't know legally what you can and can't do, whether or not, but yes, you can just ask them the question, what does your legal name show, right? Because I know for us, we aren't supposed to have a photo ID in our file at the time we underwrite it for obvious reasons. Sometimes we do, and more so if we have somebody who's a non-resident, we need their immigration documents. But, and then the third thing is the verbiage. The verbiage in the contract is so important. And when I talk about verbiage, I'm talking about things that are negotiated between the buyer and seller. And we'll get into a little bit more of that, but the one thing I wanted to talk about is repairs, okay? No lender needs to see the home inspection. There is not a lender out there that needs to see the home inspection. Number one, please don't ever provide it to us, ever. The loan would never close, okay? Number two, don't put anything specific in the contract about the home inspection as far as what the seller and buyer are willing to negotiate. You can say something like, in lieu of repairs on the home inspection, seller will pay this in closing costs. Or buyer and seller agree that they will fix the repairs that were noted on page 4 of the inspection, okay? We need that's what we need to see. And I'll get into a little bit more of that also when we start talking about property, but just know verbiage means everything. Sometimes contracts can lead us to something that we don't necessarily need to know, but because it's in writing, and I don't want to say ever leave anything out because that's just not ethical, but I think you just need to present it in a way. You need to know what's between the buyer and seller that the lender doesn't need to get involved in. If there's something we need to get involved in, we'll know from our appraisal, so just keep that in mind when you're writing your contracts. It'll make your life and ours a lot easier, and your buyers.
So don't say seller agrees to pay $10,000 to repair the crumbling foundation in the living room.
Please don't say that. Please don't say that at all.
All right, that's it. Good advice. All right, so what are some other deal breakers?
Deal breakers for getting the loans to closing or loans not approved?
Yes.
Okay,
Like what do you see?
Number one reason for loans not being approved is they did not have a solid pre-approval up front. So please make sure any buyers that you work with are using a reputable company and that you trust the person who is issuing the pre-approval, because that is huge. Any good company is doing their due diligence up front, because the last thing they want is for you to look bad and for them to look bad. So please make sure you do that. The number one reason we cannot do loans, I'm going to say, is because of income, okay? You can only pull so much income out. I mean, you know, you can only have somebody who makes $20 an hour at 40 hours a week with no overtime qualify off of $20 an hour and 40 hours a week, right? So making sure that they are in a home that is priced right for their budget. But income is the number one reason why. A buyer might disclose that they make a certain amount. You know, maybe they did. Maybe they made a ton of overtime, let's just say, I don't know, in 2022 for whatever reason, and then right now they're not making as much, we might not be able to qualify them. So income would be it. Is it fixable? A lot of times it is for a couple reasons. A, do they have assets to pay off debt? Maybe that lowers their DTI. B, can they get a qualifying non-occupying co-borrower? And I'm going to say another reason that is a deal breaker would just be credit, but that would be something that would be upfront that the lender would know immediately when they pulled the credit.
Cool.
Yeah.
Is there a list of red flags, triggering conditions to be met before closing?
Yeah, there's definitely a list of red flags. So one of the examples that I used yesterday was, again, we're looking at employment or income, okay? You have somebody who, let's just say, typically they've always made $25,000 a year at their job. Historically, that's what they've done. They've worked at this place for the last 3 years. Suddenly, after application, they have a new job. Now, all of a sudden, they went from $25,000 to $75,000, right? What was the example I used yesterday? Maybe they delivered pizzas, and now all of a sudden they're the general manager of Lowe's. Well, we know without necessarily having qualifications, that is probably not likely. That's a red flag that we're going to look into. That's something that's probably not going to close right away. Because if valid, we want to see a little bit of history. We want to make sure that this person who does not have a history of doing something where it's such a big jump and you can't make sense of it, we may say, hey, let's wait 90 days. Let's just make sure that they're, because if we're basing this off of this income, we just want to make sure everything's on the up and up and things are good. That would be a red flag. I think another deal breaker, and this, I'm sure all of you have preached this to all of your buyers, please do not open any new debt once you have sent it over to your lender. Do not go out and buy stuff. That could hurt you closing the loan, because we will. We might pull a credit, if your credit report is more than 10 business days old at the time of closing, we are going to do a soft pull and we are going to look and see, have you opened up any new debt? And as a buyer, I get it, right? Like, you have this new house, you want to go buy furniture and paintings and decorations and dishes, and you're getting all those great, you get 20% off today if you open up at Bed Bath & Beyond and all the great places. So I get it, but
Better do it quick.
what'd you say?
They filed bankruptcy. They're going out of business in like.
Oh,
in
well,
like
okay. Well, there we
6
go.
weeks.
Okay. Okay, Pottery Barn. We're doing it at Pottery Barn. So, we get it. I would do the same thing, right? I'm going to be so excited. I'm going to be ready to move into my new house, but that could, of course, hurt your deal. They may be able to pay off that debt, but then are they going to have enough assets for closing? So it's just a disaster waiting to happen. As Jeff said yesterday, if your buyers will just wait, he will drive them to everywhere they need the day after closing to get all of the stuff that they need.
Yeah, actually, it's totally, I make light of it, but I'm like, hey, here's the deal, because I've had clients that, like, literally the week after, like, dude, this holiday, this special 0% interest, 36 months, they just bought $25,000 worth of furniture or appliances, and they're like, can you believe this deal? I can't wait to close. And I'm like, bro, like, we either take that stuff back or you don't get a house. Like that doesn't work. Hey, here's the deal. Like, I tell clients out of the gate, once you close, I will drive you to wherever you want. You can throttle yourself to death. But until then, like, let's keep it lean and mean. Like, call me. You can pay cash whatever you want to. Just reference things if you're making big purchases. Please don't finance anything new without talking to us first. And that's totally joking, right? But again, it's those are deal killers, and they really can slow things down at the last minute. It's always frustrating when it's just this communication to the client. So.
Oh, absolutely. It does. And that process kind of throws a kink into everything, Then your buyer's flustered, you're flustered, the sellers are flustered, you're flustered, we're flustered, because everybody is scrambling at the last minute to try to get this loan to closing.
Right.
So.
All right, so how can agents prepare a client for a smoother process with underwriting?
Okay, well, I was going to talk about sales contracts in this specific part, but we've already talked about that. So I am going to say, number one, encourage your buyers to please, please, please get their documents early, okay? They need to get their documents in early, and they need to be communicative. That is going to help the smooth process. Make sure that they're talking to the lender. They're keeping in constant contact with you, the lender. You're keeping in constant contact with the lender, okay? That's the first thing. Second thing, please negotiate any repairs early. Negotiate them early, okay? If something happens, especially from the home inspection, if something were to happen and it's not getting done in the seller now, or the buyer's refusing, it causes a lot of problems. The longer we have to wait, the older those documents are getting. The older those documents are getting, the closer it is that we might have to ask for new pay stubs, new credit docs, new assets, right? What's that gonna show? Is something gonna happen, right? So negotiate the repairs early in the process to get done so closing's not delayed.
Awesome. So in a new build that can take 6 to 12 months, how can we best prepare clients for the process from your perspective?
You know, on a new build, it's going to be the same story. The way that they apply for the loan needs to be the life that they live when they close the loan. 6 to 12 months is a long time to wait. A lot can happen. There can be job changes. There can be, anything can happen, different life events. Make sure that no matter what goes on, you preach to your client that they stay in touch with their lender. If there's a change of job, great, let us know right now. Let us get a pay stub. Let us make sure you still qualify. I think the best information, the sooner you know, the better it is. Because if something were to happen, I don't know enough about what goes on your end with new construction, but I'm sure it's not fun to tell a builder when you're getting so close to closing that they can't close on the house after this house has been built to our buyer's specs for however many months. So it's just that constant communication all the time with your buyer and what to expect. Let them know that just because you got approved for the loan today doesn't mean you're gonna close 12 months from now that easy. Like, you will close as long as nothing changes, but you can't take it for granted that you have this approval.
You hit something in that answer that just reminded me of a saying we have around our office is bad news doesn't get better over time. We can fix anything on day 2. Day 22, it's a little tougher. So if you know of something, get it out there in the open. We can get to plan B now. If you wait for plan B, thinking plan A is still going to work, and you know that there's something that's impacting plan A, get to plan B right now, and we can fix pretty much anything.
That was my question. So I actually, just to go over that a little bit more in depth, how often do you guys ask for stuff from clients during that period?
The question is-
That was part of me the first time doing any construction.
Yeah.
Was, like, how often they were being asked and how, like, my client was yelling at me constantly. He's like, what's going on? Why are they asking for all this stuff?
That's a great question. So once we have the initial loan approval, we have everything we need for the loan approval. Credit documents typically expire within 120 days.
Did everybody hear that question, by the way? How often they ask for stuff? How often do we ask the clients for stuff during the process of a new build? Just so you know.
Yeah, so they expire within 120 days. So if the loan has not closed from our doc expiration date, and typically the way it works is our document expiration date, everything's on 120 days. So your loan approval will expire the first document that expires. So let's just say your oldest document in the file is your bank statements from March 1st. Everything else is dated, or let's say your credit was dated March 1st. Everything else is dated towards the end of March, beginning of April. March 1st is when your approval actually expires. That's the day we have to pull new credit, July 1st. Then the other docs expire sometime in April, right? So now we're looking at, if it hasn't closed by August, we need new income, we need new assets. I mean, I'll be honest, even with the property, after 120 days, if we have the appraisal and the home's not done yet, we have to get a recertification of that value. So 4 months is the good rule of thumb to go by once you have the initial approval. You're welcome.
So this next question, this is important because it's happening right now in our, here. So taxes and insurance. How do you view city and county tax reassessments of properties if the tax bills are not out yet? So that's what's going on right now. We just had a massive tax reassessment. Tax bills don't come out for a couple months, and we're in this limbo of hey, well, what do we do, right? How does that handle from an underwriting standpoint?
We can only use what the taxes are currently, and we can't predict what they're going to be. Now, if we know that a reassessment has already happened and the bills haven't come out, we still don't even know what the assessment of your property necessarily is. We may go on and look to see if possibly the millage rate has changed. But again, with the fact that we are a national company, we don't necessarily have a lot of time to do that, so we'll typically go off what the taxes currently are. There are a few exceptions to that. Number one, if the current home, if the seller has exemptions that the borrower doesn't qualify for, we might have to use the rate with it being without the exemptions. Number two, new construction. We're not gonna lend on the land, we're gonna lend on the fully improved tax amount. What we will do is we'll just take what our value is by the millage rate and come up with it that way. Yeah.
No, I mean, didn't you say like something about the 1.5%?
Yes, if there's not a millage rate, which I do believe here there is, if there's not a millage rate in some areas, we do have to just take the value by the 1.5% over, yeah.
Yeah, and I know a lot of closing attorneys, I've talked to several, and they're like, hey, we'll have an affidavit signed that if it's more than 10%, if the adjustment's more than 10%, that the seller is required to make the buyer whole after closing. It's just an interesting thing, because it's like, hey, do we adjust it now and take the higher amount? Because at the end of the day, if my payment's gonna be $50, $75 a month higher, then I'm like, I would love to know in advance. You know what I mean? So like, I don't want to be caught off guard after I move in, settle in. It's like, hey, by the way, your payment's up $100. You're like, what? So those are things that like we want to make sure that we're communicating that and as best we can.
So can you walk us through what needs to be done on condos and why?
Okay, condos. Has anybody ever had issues with condos? I'm getting your, okay, I'm seeing quite a few hands. All right. So there's two different types of condos out there, okay, when it comes to the lending side. There is our warrantable condos, and those are the condos that we can warrant to sell to the agencies, okay? Then there's our non-warrantable condos. Those are the ones we can't sell to the agencies. We do have outlets for them, but they're not easy outlets. So let's just talk about what those mean. Warrantable, that's typically your home that somebody's gonna live in. You know, a condo that you buy across from South Lake Mall, or
Park.
South Park, sorry, South,
You got it.
yeah, South Park Mall. I feel like South Park is the, never mind. Cartoon, okay. Anyway, actually I live where South Park was, created off of, so Fairplay, Colorado, near there, yeah. But anyway, so, the condo, it is where they live. That's your typical, having their family there, second home, whatever, right? That's typically our warrantable condos. Most of the people that own it live there. There's nothing, nothing really different than living in a single family home. You just share a party wall and there's an HOA, right? Then there's those non-warrantable condos. Those are the condos that you see in like Myrtle Beach, at the lake, in the mountains, the resort type areas. The ones that are considered like condotels. And those are the ones where, there might be a daily cleaning service. There's a front check-in desk. They have room rates by the night. It is something to that effect. Those are considered our non-warrantable condos. Those are a lot harder. Some of the things that we do look for when it comes to a condo is we want to look at how many units are occupied as a primary residence versus, or how many are primary and second homes versus investment property. How many are non-owner occupied, okay? We want to look at, what does the budget look like for the condo? Is there sufficient enough for reserves? We want to look at how many phases are there? How many units have sold? Those are the things that we look at, and I'll explain the reason why behind the condo. So one of the reasons is a higher risk loan, especially for the lender. I'm not going to say for the buyer, but for the lender. If it is a high concentration of investment properties, a lot of times when you think about it, when people have financial issues, what do they pay first? Their house, and second, they pay their car. That is what they do. Pay their house because they need a roof over their head. They pay their car because they need to get to and from work to be able to pay for their house. They have an investment property that maybe they're not getting income on, or that they need repairs and they can't get rented, they'd be more apt to let that go, okay? So if you have a building that is full of condos that are investment properties and they foreclose, what does that do to if I own one, my property value? It goes down. So it's riskier for the lender to have any kind of lending interest into a building that is high with investment concentration.
Makes sense.
Yeah.
You want to ask that one on title insurance?
Yeah, sure. Why is there title insurance? Lender and borrower title insurance, and what does it exist for, and what's the difference?
Okay, and it's an easy answer. Borrower title insurance is to protect their ownership in the property. Simple enough. It's to protect that they are the owner in the property. Lender's insurance protects our interest in the property, meaning that if we do the loan, we want to be in first position. If something happens, we want to have rights to foreclose on that property. We need that insurance to protect our position on that title. So because we want to be in first place, we want to make sure that there's not some sneaky liens that are going to pop up at some specific, point in time. Tax liens. I mean, we've seen liens that were against other people put on our properties before. So that's super, super important to protect our own position, because that is also our financial asset.
And if the house ended up, or the place ended up going into foreclosure, whoever's in first lien position gets paid first, second lien gets paid second, third. So if we're like, to your point, if there's taxes or people that are owed money and they're in first lien position, they get money first when the house is sold. And we're the biggest liability, we want to be paid first.
Right. Now, every once in a while, there are certain liens that will supersede us, but those are few and far between.
Right.
Yeah.
Right.
All right, so does FHA allow family members to be on the loan, or what restrictions are there? What about other government type loans?
Okay, so FHA, yes, you can have family members on. Okay. Yeah, okay.
What?
Sorry.
What was that?
10 minutes. FHA, yes, you can have family members on the loan. Actually, every type of loan, you can actually have family members on the loan. However, there are some exceptions, and I'm going to try to talk fast because I know we're limited on time. So, if both family members are occupying the property, that is not an issue whatsoever, okay? That's for FHA, conventional. VA, it's a little bit different. I'm not going to go into that because that's a little confusing right now. But, yes, where you start to have issues when it comes to people being on the loan is when it's a non-occupying co-borrower, okay? If you have a non-occupying co-borrower, very common on FHA loans, right? First-time home buyer, they might need a little bit of help. If it is not an immediate family member or a family member that is defined by FHA, it limits our loan to value. So if you have somebody who wants to co-sign for a borrower who is not a family member, they're limited to an 85% loan to value. I don't know if you guys knew that, but they're limited to an 85% loan to value, which is why it's important. But yes, to answer your question, family members can always be on the loan.
Cole, can we jump into the property condition?
Yep, go ahead.
So this is important because y'all are out there, you see the property, right? Does the condition of the roof matter? I'm just curious.
Yes, no, it absolutely does matter. Now, so conventionally I would say conventional is the most lenient when it comes to things like this. We depend on the eyes and ears of the appraiser, right? They're our eyes and ears. They're the ones that are telling us what's wrong. FHA requires 2 years roof expectancy, life expectancy on the roof, otherwise we will need it to be replaced. Conventionally, if something is noticed by the appraiser, we may ask for a roof inspection. If they see stains on the ceiling and that indicate a possible leak, they'll note that in the report. Sometimes they don't note that in the report, but they put a big, nice picture of it. So we're going to ask for a roof inspection to ensure no leaks. A lot of times inspections come back fine. Sometimes we do require the roof to be replaced if it's in bad condition.
Makes sense.
Yeah.
What about the overall condition of the property?
Overall condition of the property. So our goal is to make a loan to a property that is safe, sound, healthy structure for the borrower. We do not want to put a borrower into a dangerous property, something that could affect their health or their safety. Deferred maintenance, that we're not worried about that. Some worn carpet, some peeling paint, as long as it's, after 1978. The little things like that, some cosmetic things, that's not what we're worried about. We're worried about, is the wall cracked all the way up the structure? We're worried about that deck that has a hole straight through it, no handrail on stairs where somebody could fall. We're looking at, that back door that doesn't, you open it up and it's a 30 feet fall. That is what we're looking for. We are looking at, for the property to be basically, I guess, safe to live in.
Are water tests required for any property type being financed with a well, or only certain types of loans?
Okay, not all properties are going to require a water test. Now, when it comes to FHA, any new construction is going to require it, okay? Any new construction is going to require it, and if the appraiser notes any appraisal deficiencies, again, it might not be a new construction, but they may notice something with the well, and they're going to ask for it. We will require a water test. VA does require it on every individual and shared well, and conventionally, again, only appraisal deficiency. Or if the well is located near some kind of hazardous site, industrial site, farm with pesticides, dumps, landfills, things like that.
Yeah, listen, I will say this, my best agents, they're on the ready, they call us and be like, hey, I'm sitting at this property, I'm concerned. They'll snap a picture, text it, and then we get quick answers. So just know that every customer is going on.
Okay, do you want to skip appraisals?
You want to skip appraisals? Or if it's not an issue. So just know that. Shared driveways, is that an issue?
As long as there's a recorded easement, no. As long as we have some kind of recorded ingress-egress, shared driveway agreement, something like that, no. We want to make sure whoever they're sharing it with, that they play nice, they don't get invited, they both agree to maintain it, things like that.
Makes sense.
All right, appraisals, how often are they appealed? What's the process?
I mean, really, the only time they ever appealed is if they appraise under sales price. I mean, that's when we appeal it. You know, when that happens, and it does happen, right? And again, I say it about underwriting, appraising is not a science, it's an art. Two appraisers are gonna look at something completely different. We rely on you guys heavily for that stuff. If you have comparable sales and you can provide us property data to show why the property is worth what the sales price is, or if the selling agent has it, right? Or I'm sorry, the listing agent, if they have it, that would be amazing. Because what we do is then we get that information, we present it to the appraiser because maybe there is something they missed and they see it and they're like, yep, I get it. They slap it on and our value's where we need to be, or sometimes they don't and they don't do it. And then we either A, will try to flaw the appraisal and order a new one, or B, the sellers might, you know, negotiate a lower sales price.
That's it. Okay. We're going to jump on to credit. There's been an update on how medical collections affect qualifying. Can you talk about that?
I can. Okay, so medical collections. Now, they could hurt your credit score. That's the one thing that we can't necessarily dictate, although, isn't there?
They'll delete if they're paid. So you can actually boost credit scores pretty quickly with payments of collections, medical collections.
Well, yeah, but I was also thinking that for mortgage purposes, they weren't going to include them anymore. Never mind.
Yeah.
Okay.
Yeah,
So for qualifying reasons, at least for us, I mean, the credit score is one thing. We can't dictate that. But we don't actually ask medical collections to be paid off. We understand insurance companies are really hard to work with, so we don't look at medical collections like your typical collection. So typically, it's not going to hurt your transaction at all if the borrower has a lot of medical collections, except for how it impacts his credit score.
Makes sense.
All right, we got the 5-minute warning, 5 questions left. Speed around. What's considered, super hot topic right here. What is considered variable income and what do you look for?
Okay, variable income. Variable income is considered anything that is not your standard 40 hours a week or salaried borrower. You're looking at bonus, commission, tip, overtime, fluctuating hours. That is considered variable income. They're going to start talking about the price adjustments in the next segment, but one of the reasons why it's become such a hot topic is because there is a price adjustment if our debt to income ratio goes above 40. So right now, it is super, super important that we are looking at variable income and we understand how to calculate it. In the past, underwriters always took the stance of, if it's not needed for qualifying, if I don't need your overtime, if I don't need your commission, I'm not going to ask anything for it because we don't need it. Now, we're going to be asking for it for a little bit more because we are going to need it to keep that price adjustment down. Agencies are pretty strict. They don't let us just look at it and look at their pay stub and take what it is. We have to use a history. We have to look and see what they've made in the past. I'll give the example I gave yesterday. Sorry, Matt. I live in Colorado. There's a lot of amazing ski towns right there, right? Ski season, especially in the beginning of the year, January through April. I have somebody who works at a restaurant at one of those ski towns. Their tips are going to be great. If I look at their tips and their year to date compared to what they made last year, they're on pace to make a lot more this year than they did last year. However, same borrower, give me your pay stub in July. Where are we now? Because it's dead. From April to July, there's nobody. So that's one of the things we have to look at and take into consideration when it comes to variable income.
That's a great example, too. What do you look at for a 1099 client? What advice can you give an independent contractor looking to get a mortgage?
Really good question. I don't think we had this. I don't think we went through this yesterday. So 1099, you guys, I'm sure, are all 1099s. You guys know you are considered self-employed, right? Whether you have formed, an S corp or some kind of partnership, or you just file on a Schedule C, you are self-employed. Okay. I am going to say one of the biggest things is that if you have an independent contractor who has not, either towards the end of the year or this year, who has not filed their tax returns yet, have them work with a lender first before they file. Because you know what the number one thing people that are self-employed do? Write everything off. Exactly. Great for you when you have to pay taxes, but now you don't qualify for a house, right? And we know, trust me, we know that, you're going to write off anything and everything that you can. So I'm going to say if you have a buyer who is self-employed and their tax returns are not filed yet, please have them work with their lender before they do.
Yeah, we deal with that quite a bit where clients are like, hey, in order to be able to qualify for this price point, this is a rough idea based on other debts that you would need to claim that you make in order to qualify. And I've had a lot of people that run successful businesses, they're like, all right, I'm cool with that because because they do everything they can to minimize their tax burden. They understand that they're gonna have to claim a little bit more money, and it's.
They're gonna have to write off a little less expenses. I'm not gonna say have them claim more money. I'm gonna say have them write
Yeah,
off.
right, sorry, that's the two different, languages there, so my apologies, but that's
Kidding.
ultimately, what we're talking about, so.
And get them to us early. Your loan officer can load them up, click a button, a scenario request. An underwriter on her team will jump in, underwrite the income before you have a contract, or before we write a pre-approval, and then there's no questions asked.
And
One
we're,
last question too, before we open it up with some questions. Can a realtor's commission be used for down payment or closing costs and prepaids?
okay, down payment, no. Okay, your commission can never go to any of the borrower's down payment. However, your commission can go to their closing costs and prepaids. If you want to contribute it, we do have a max percentage of interested party contributions that are required on loans depending on the LTV, okay? Understand that those contributions combined with the seller's, yours, they can't exceed a certain percentage, but they also can't exceed what the closing costs and prepaids are, okay?
Yep.
So, example, the seller has negotiated $15,000 in closing costs and prepaids, right? But the closing costs and prepaids are only $9,000. They can't use that additional $6,000 for something else. The buyer can't get some kind of credit or rebate at closing, okay? So really important to know up front have an idea of what those costs are and what you're negotiating, because again, it could end up causing the deal to be a little bit sketchy at the end, or hairy at the end, I guess I should say, if the buyer was expecting to get $15,000 and they're not.
Yep. And real quick, because I want to open up some questions too. We have these, we got some realtor cheat sheets that we've put together and laminated. This is the whole point of these. Is toss them in the car. And these are great things, like point of references as far as what's required, minimum down payments, different things that just to be aware of. So just a heads up that we did that for you, and these are great tools that just to have at the ready when you're out serving clients. So we did want to take a few minutes and open it up to some Q&A. Anybody have any questions they want to ask Michelle while we've got her here? Matt, can you take them? Perfect.
Jordan's got it.
Got a mic?
Got a mic?
Thank you so much for your good.
Thank you.
I have a couple questions. So are the 40% that's not 60% is sold to Fannie Mae, Freddie Mac, or whatnot? Where does the other 40% go to private?
Other 40% would be your FHAs, your VAs, USDAs, jumbo loans, the ones that are non-conforming going to private investors. But Fannie and Freddie, they typically service just the conventional loans, or I'm sorry, they buy the conventional loans. Ginnie Mae does the VA, HUD does our FHA.
Yeah, the most recent breakdown is about 60% Fannie, Freddie, those are conventional loans, about 20% FHA, VA, USDA, and then that leaves another 20%, 15 to 20%, like your banks, credit unions that either have specialty products that are not sold in the secondary market. They make the loan, they hold it on their balance sheet and collect the payments themselves, and it's normally, either Community Reinvestment Act type loans, jumbo loans that are like a specialty product. Maybe you got a bank that does doctor loans, stuff like that, or you have, or credit unions may have, like a 100% 3-year ARM or something that they do for first-time home buyers, something like that.
Okay, and then thank you, that's great. And I probably should know this, but I don't. So what exactly? I know we have to buy private mortgage insurance.
Good question.
What exactly am I insuring with that? Because people still go into foreclosure.
Mhm.
People still, have these issues. What does private mortgage insurance really pay for?
Private mortgage insurance really protects the lender. They will insure up to a certain amount. If the loan is over an 80% LTV on a conventional loan, you have to have private mortgage insurance. And of course on FHA, you have to have mortgage insurance premium. It does protect the lender up to a certain percentage on a higher risk loan. That's
So just
pretty much the
so
best.
for some scope there, $100,000 loan, the bank knows that, hey, if we foreclose, we're going to be lucky if we can sell it for 80%. So they're going to be exposed to losing 20 grand. Plus legal fees, plus carrying the cost of the mortgage until they actually sell it and get it off their books. So they go to a private mortgage insurance company and say, hey, we need to buy an insurance policy to cover this risk that we're exposed to. So if the borrower defaults, the PMI company comes in and basically makes the lender whole or more whole on that delta. Does that make sense?
Yeah, but then they make the buyer pay for it.
Well, yeah, absolutely. It's a buyer paid expense because ultimately the buyer doesn't have 20% to put down. And so prior, like
Right.
back in the day, people had to come with 20% or more down. That was just it. So these PMI providers have come into the mix. They've come into the field and they're like, hey, we'll get you. So, but we're gonna, and then we'll offer a PMI to be able to like, hey, if the lender does want to go up over 80%, 90%, 95%, 97%, 100%, we got it. We'll cover that risk for the bank because that gives the bank a little bit more comfort level of going higher than that 80% mark. Does that make sense?
Yeah, I think part of the confusion too may be the term, it protects the lender. It actually protects Fannie Mae or Freddie Mac.
Well, yes,
And they're the
yes.
ones who send the money to the lender to do the loan. So they buy the loan from the lender, and that's who it protects. And Fannie and Freddie have said, hey, we used to be at 80%, we'll go 95, we'll go 97, but we wouldn't do it without this protection.
But now they're keeping it throughout the life of the loan.
That just depends. Yeah, I mean, like there's it depends on the loan to value. So the FHA, if you put a certain percentage down, it cancels after, is it 11 years or 10?
I don't think it's ever canceled once. It's,
Okay.
yeah, they stopped it, yeah.
Okay.
Yeah, they'd have to fully refinance out of it.
So they would refinance out of the FHA loan into a different loan program. That's ultimately what we do a lot of.
Yeah,
So-
and conventionally, I mean, they can always ask for the loan to be reamortized. They can have take a look at it and see and have the loan reamortized out to get the PMI off. Yeah, but but to pay it down to an 80% LTV probably takes quite a few years. A lot of people will make a principal only payment and have the loan recast to drop the PMI.
Yeah. And I will say this, as rates are going down, they're forecasted to be into the mid to low fives this year. We were just on a call yesterday, they're forecasting rates in the fives and the mid fives as early as the summer. So man, amen, like that would be great. They're also forecasting as we're pressing towards a recession, which we are, that the feds are gonna get involved, they're gonna start doing some things, and that they feel, when I say they, Fannie Mae, Freddie Mac, the Mortgage Bankers Association, they're forecasting interest rates to get into the mid fours next year. So whatever the clients are in today is not going to be a hole, and it's not like, oh my God, I got my loan at 6.5%, I guess I'm stuck. We need to make sure that we educate them on like, hey, this is a two-step process. What's the best short-term strategy and long-term strategy? Because we're going to get you in the house today with this rate and this strategy, but we're going to position ourselves to refinance when rates come down, and this is when you're going to get into your forever loan on this property when rates come down. Does that make sense? So I just wanted to plant that seed there too. Any other questions that we've got, Michelle?
Hi. Right.
I'm just wondering, with him having $100,000 to put towards, the property, essentially that would probably cover 20%. I'm thinking they're looking at 400 or 500. He can put 20% down, but again, he has excellent payment history on his mortgage, but he had some lenders that were recovered 5 years ago.
Gotcha.
So, I mean, he could take that money and pay it off. I told him we can get because, of course, depends on what the underwriter would say. I don't know if it would work or not.
Okay, so first of all, I'm going to say it's always worth a try, right? Get his credit, or lender get his credit. They're going to take a look at it and see if his credit is eligible for us to do it, right? If he cannot be on the loan, and from what I'm understanding, her income is limited, correct? Okay. Okay. So first of all, that $100,000 can come from the dad, okay? Because it would be a gift, and family members are allowed to give gifts, okay? So that's first and foremost. So yes, so let's just assume he can't get on the loan. There's going to be two things we're going to look at, right? Number one, can she afford this home on her own without his income? How is the DTI, right? If the DTI is high, my suggestion would be, how much debt does she have? She has great credit, but does she have some debt? Can we use part of that $100,000 to pay off some debt and use the rest of the down payment to get her payment lower? Okay, so maybe he doesn't put all $100,000 towards the house. Maybe he's giving her some money to help her pay off some of her debt so she has less bills when she gets into the house. Most of these situations are doable. In all honesty, that is definitely something that you would want to make sure they have a solid pre-approval up front, because you would want to know the price range that she could afford if the dad cannot be on that loan.
Right, but she's pre-approved now under a credit union, but it's only 200,000, and that's just,
Not
yeah,
enough.
binding in Charlotte.
Yeah.
Right, right.
Yeah.
So I was like, what can we do, daddy's retired, and I was
Pay off that $500 car.
So if he cannot be on the loan, if you're doing a conventional loan, understand anybody can be a non-occupying co-borrower. So if there is somebody else in her family or somebody who's willing to go on, especially just for the use of the income to afford the home, who's willing to co-sign behind her, that's always an option as well. Dad can still give the gift.
So those are two things there too, because you've got if it's a down payment thing, that's a gift. But if it's income reasons, then obviously you need to bring their credit into the picture. Because you don't have to be on the loan to be able to gift money.
Correct.
Right? But I mean,
Correct.
what you do if you want to throw your income in the mix, you have to be on the loan. We got to pull credit. But there's a lot of times we deal a lot of this where our ability to provide service to clients is you have to understand how credit works. So if there's things that we can look at dad's income, dad's credit, and say, hey, we need to do step 1, step 2, step 3. We're going to get your scores up to where we can get you on the loan. Just know that that's something there too. There's options there. You just need to be able to pull it apart and put it back together. And like I said, to Michelle's point, sometimes I've had situations where you've paid off a car payment, a car with $20 grand, and that's eliminating a $600 or $700 payment. And now all of a sudden that qualifies them for an extra $100,000 in
Right.
mortgage.
You don't need his income anymore. You just need the
Right.
assets. Yeah.
Yeah, there's a lot of stuff there. All right, so I
No, we had one in the back before. Yeah, that is actually a great question, and one of the reasons with variable income. Let me go there really quickly. So in the past, underwriters, if we didn't need that income to qualify, we could qualify them off their 40 hours a week. We didn't need that bonus or their commission or anything like that. We would qualify them off what we needed and we ran with it, right? Loan level price adjustments. When, if, I guess, and when they come into play, anything that's above a DTI of 40% is going to be a price adjustment on, well, the borrower. And so why variable income is such a hot topic right now is because now we're going to need it to qualify, right? So the way that we are instructing our underwriters is, you know what? If they're submitting the loan and there's overtime and bonus, let's go ahead and get it documented. Maybe we don't need it right now, but maybe we will. Maybe it's just a TBD, it's a pre-approval, but when they get the house, it might be a higher price range, and now it goes over that 40%. We want to make sure that we're able to use that income. So that is one thing about the price adjustment that I can talk about. And
we'll cover that in more detail next. So, you have a question as well?
Yes, do you guys do down payment system for buyers?
Yes, and we are. So these are wonderful questions. So the next group, and we've got our DPA specialists that are going to be coming up and presenting on the DPA. We're going to be covering that here next.
As far as year to date, that you talked about, what about realtors if you want to buy property? You want to buy property for, its commission, you said you can't use, say, 21 or average 22 or for the realtor.
Okay, so for a realtor, how we would look at their income is, obviously with a realtor's income, you might have a month or two where you didn't sell a property, and then you might have a couple months where you sold a couple. We know it's not a consistent source of income, correct? So we'll typically look at your history, okay? Now, if it declined in 2022, there's not much we can do, but what I'll also look at is I want to see, do you have any listings? Do you have any buyers under contract? What are you doing right now? What have you done so far this year? Like, that's what I'm going to look at to see what the consistency of income is to make me feel good about a qualifying number.
Maya Smith with Freedom Living Realty. Thank you for presentation.
Oh, hi.
I saw a video, a realtor from Miami was talking about options for non-residents and non-citizens. Is any option with the loans in that scenario?
Yes, we do offer loans for non-citizens and non-residents. For non-residents, it's a little bit more trickier because if they're living overseas, it's a manual underwrite for us. We can't put it through a system. So if you're talking about somebody who lives are you talking about somebody who lives overseas? Somebody who lives here who's just not a U.S. citizen? Yes, we can absolutely do loans for borrowers who are not US citizens, whether they're a permanent resident alien or a non-permanent resident alien. What we do is we'll look at the type of visa that they're on, when it expires, and the history of renewals. There's not many visa types that we can't do. The biggest thing, if it's going to expire soon, we just need to make sure it's one where the renewal is probably going to be a guarantee, because we just have to make sure that they're legally in the States to be able to, yep.
Anybody else have any questions they want to ask?
I love this.
I actually have two questions.
Yeah.
You kind of touched on it a minute ago, so I'm sure I didn't miss it. But so two people want to buy a house, but they're not married, like boyfriend, girlfriend. Can they both be considered as income, or no, or is that very prolonged?
No, if they're both, wait, did you ask if their income can be considered?
Yeah, can you use both their credit scores? So
Yes. So yes, if they're buying a house together and they're both going to be on the loan, absolutely.
And then for people that filed forbearance back during COVID, does that have any impact at all?
Forbearance on, for mortgage companies?
Yeah, so people during COVID that didn't make their payments and filed forbearance, does that have any impact when they go to buy?
It does. So really, we're actually probably past that at this point, because I think most of the forbearance has been lifted for COVID. But if they are currently in forbearance, they have to be out of forbearance, and they have to make 3 consecutive payments on their mortgage. It can't be prepaid before we can entertain doing a loan for them. So if they came out, in February, they'd have to make March, April, May, and again, not prepaying it, and then in June we could do a loan for them.
All right. Anybody else have any questions for Michelle?